In this chapter, we talked about the return risk and the security market line. And most importantly, we talked about one of the most important formulas in corporate finance, CAPM model. We first talk about the expected returns and variances, portfolios, and then we talk about some definitions of the diversification of the unsystematic risk. And the risks that cannot be diversified are the systematic risks and its relation with beta. The risk and returns have a relationship, and relationship can be described by the security market line, which will give us the CAPM formula. Expected return and risk variance. Expected returns are based on the probabilities of possible outcomes. In this context, expected means average if the process is repeated many times. The expected return does not even have to be a possible return. It means the average expected return in the future. So in the future, there may be different states. For example, the state of the economy could be good, average, or bad. So under each state of the economy, your expected return from this business could be high, average, low. But you don't know which state will be in the future because the future hasn't happened yet. But you can calculate the average return of this business. And that average is called an expected return. So in formula, the ER is equal to the probability of each state I times the return I under this state. If you are not very familiar with the sigma sign, it basically means P1 times R1 plus P2 times R2 plus P3 times R3 plus blah blah to the nth state. If there were nth states, nth possible futures, then we have n p's. Okay, each pi denotes the probability that this state can happen. For example, suppose you have predicted the following returns for stock CNT in 3 possible states of the economy. What are the expected returns? C is Citibank. C is a ticker in the U.S. market. It's for Citibank. T is for AT&T. It's a telecommunication company, kind of like China Mobile or Verizon. It's a telecommunication company. State of the economy can be boom, good, normal, average, recession, bad. And we think the probability of a booming economy is 30% or 0.3. The normal state is 50%. And recession is 20%. And we think this returns for Citibank stock when the economy is booming is 15%. When the economy is normal, we expect that the Citibank stock return is 10% and in recession 2%. And AT&T stocks return should be 25, 20, and 1% when the economy is booming, normal, and in recession. To calculate the expected return, RC is equal to the probability times the return of Citibank stock under this probability, under the booming state, plus the normal probability that the state is normal times the stock return when the state is normal, 0.5 times 10%. Then plus 0.2 times 0.02 is equal to 9.9%. Similarly, we can calculate the expected return for AT&T stock as 0.3 times 0.25 plus 0.5 times 0.2 plus 0.2 times 0.01. and the average expected return for AT&T stock is 17.7%. This is the expected return or the expected mean average return. And we want to know the volatility. Okay. You may have two stocks with the same mean return but different volatilities. Say, if you have a stock that has 9.9% return, no matter the state is boom, normal, or in recession, that state the return of that stock, hypothetical stock, is very, very stable. And the risk is zero. By holding that stock, you have zero risk that the return will be different than the expected return. But here, you're almost assured that the returns must be different than the expected return. The question is just how much. So we say for CNT, the risk, the volatility of the future returns are higher than that hypothetical stock with 9.9 returning average state. How do we measure the volatility? We use variance and standard deviation. If you learned statistics before or probability theory, it should be easy for you. But if you haven't, don't worry, we'll explain again. We use unequal probabilities for the entire range of possibilities. And it's basically calculated as a weighted average of squared deviations. So there are several important concepts. Weighted average of squared deviations. What is deviation? It's a deviation of the actual return from the expected average return. Because the deviation can be positive or negative. If the actual return is higher than the expected return, then the deviation is positive. If the actual return is smaller, is lower than the average return, the deviation is negative. Okay. To calculate the average of the deviation is meaningless because it must be zero. Okay. Because the mean, the average is calculated from the weighted average of the actual returns. The expected return is calculated from the weighted average of actual returns. So the average of return deviations must be zero. So we want to get rid of the negative sign, then we calculate the square of the deviation. And then we calculate the weighted average of the square deviations. In formula, it should look like this. We first calculate the expected return. Then we calculate, under each state, we calculate the actual return under each state minus the expected return. That is the deviation. Then we calculate the square of this deviation. And then we multiply that by the probability. And we calculate the multiplication of the probability and the square deviation in every state. Then we sum them up. So we can calculate the sigma square. Sigma square is denoting the variance. And if you take the square root of the sigma square, or the variance, we get the standard deviation. Example. Consider the previous example. What are the variance and standard deviation for each stock? To calculate standard deviation, first we calculate the mean, the expected return, which is 9.9%. We calculated before. So then we, for each state's actual returns, we calculate the deviations. The actual returns minus the expected return. Then we calculate the square times the probability of this state. For 0.15, the probability of the booming state is 30%. So 0.3 times 15% minus 9.9% square. And this is normal normal state's probability, and this is normal state's actual return minus the expected average return square. And this is a recession's probability, and this is a recession's actual return minus the expected return square. And we get 0.002029. And this is the variance. And standard deviation is the square root of it, which is 4.5%. Similar for stock T, we can calculate following a similar approach. You see that the expected return is 17.7%. So 17.7% are there here. And 0.25, 0.2, 0.1, they are the actual returns in the future under different states. They're here. And 0.3, 0.5, 0.2, 0.3, 0.5, 0.2, they are the probabilities of each state. So you can calculate that the variance is 0.007441. And by taking the square root, we know the standard deviation is standard deviation is sometimes called standard error. Okay, they are the same, standard error. ERROR, standard error. The standard error is 8.63%. So we know that the stock AT&T stocks standard error is greater than the standard error of Citibank. So this stock's volatility is greater than the Citibank's stock return. Okay. Here there is this is another tutorial question. You can calculate it by yourself. Now we wanna calculate the portfolio or the portfolio return. Okay. A portfolio is a collection or a basket of assets. What is a portfolio? It's multiple assets. Say, if you only have the Citibank stock, that is a stock. If you have a Citibank stock and the AT&T stock simultaneously, the combination of the two stocks is called a portfolio. Then you add another stock of Alibaba. This is another portfolio of 3 stocks. If you change the weight of each stock in this portfolio, it becomes another portfolio. And assets risk and return are important in how they affect the risk and return of the portfolio. When we talk about asset allocation, we are talking about what kind of stocks or assets we should put into a portfolio and the weight of each of them. The risk-return trade-off for a portfolio is measured by the portfolio expected return and standard deviation, just as with individual assets. Suppose you have $15,000 to invest, and you have purchased the securities in the following amounts. What are your portfolio weights in each country? So C is Citibank, KO is Coca-Cola, INTC is Intel, BP is the British Petroleum. Okay. So what are your portfolio weights in each security? You see that the sum of these 4 numbers are 15,000. The weight is calculated very directly by using the amount you put into each security divided by the total amount that you invested into this portfolio. So it's just a 2 divided by 15, or 2,000 divided by 15,000. So you get the weights are 13.3% for Citibank, 20% for Coca-Cola, 0.267, so 26.7% for Intel, and 40% for British Petroleum. The expected return of the portfolio is a weighted average of the expected returns of the respective assets in the portfolio. So it's calculated like this. You first calculate the expected return for each stock. Then you just calculate the weighted average of these. So you use the weight times the expected return of stock 1 plus the weight of stock 2 times the expected return of stock 2. Okay. You can also find the expected return by finding the portfolio return in each possible state and computing the expected value as we did with each individual securities. Consider the portfolio weights computed previously. If the individual stocks have the following expected returns, what is the expected return for this portfolio? We have these returns and we have these weights. So you just multiply the corresponding expected return and the weights. So the probability, the weights times the 19.69%, which is the expected return of C, plus the weight of Coca-Cola, 20% or 0.2 here, times the expected return of Coca-Cola, 5.25%, plus the weight times the expected return for Intel, and that for British Petroleum. And then we use the E expected to denote expected return of this P portfolio is 15.41%. Okay, you see that the expected return of the portfolio is always not that extreme, and in between is greater than the smallest expected return of any asset in this portfolio, and the smaller it's greater than the smallest expected return of an asset in this portfolio, and smaller than the greatest return, which is the expected return, which is the Citibank's return in this portfolio. Okay, it's in the middle because it's the weighted average. Portfolio variance. Compute the expected portfolio return using the same formula as for individual assets. Compute the portfolio variance as standard deviation using the same formulas as for an individual assets. Okay, this is for the this is the formula for the portfolio variance calculation. Okay, you can just use it as your practice or in the tutorial. And by the way, this is very likely to be covered in the final exam. This is another tutorial question. Now we have learned how to measure the expected returns and the volatility. Now we have done this. And now we talk about the expected versus unexpected returns. The realized returns are these returns. The 50 the realized returns are like the actual returns that I said. It's like 15%, 10%, and 2% for C, and it's rarely or equal to the weighted average, the expected returns. So the deviation between the realized return and the expected returns is either positive or negative, okay, or sometimes zero, if the expected return happens to be the realized return, but this rarely occurs. So there is an expected component and unexpected component in each realized return that you have. So the realized return minus the expected return is an unexpected component of the realized return. And the average of the unexpected components over time will be approaching to zero. Efficient market announcement surprise. Announcement and news contain both an expected component and a surprise component. It is a surprise component that affects the stock price and therefore its return. It's very obvious when we watch how stock prices move when the unexpected announcement is made or earnings are different than anticipated. What does this mean? What is announcement first? The companies will make announcements about this financial condition and how the status quo of the company. For example, a company can say its EPS, earnings per share, is $2 per share. Will these cause its stock to go up or down? We don't know. We need to compare this with the expected component. That is, the market and analysts will, based on their research, they will give a expected EPS for this period. For example, $1.2. If the announcement $2 per share is higher than the expected component, then the stock price will go up. If they expect that the EPS is $3, then the stock price may go down. This is why very often you see the annual report of a company says, hey, our annual return, our total sales grew by 100%, but you find that the stock price is going down. You may wonder, like, isn't 100% growth very high? Well, yeah, it's pretty high. But the market expected that the sales could grow at 200%. So they actually priced the stock supposing that the sales growth can be 200%. But in reality, they release the financials and say, hey, our growth is only 100%, then the stock price will go down. If the market anticipated that the expected growth should be 50%, and you say how your growth is 100%, then the stock price will go up. How do you get the analyst focused and the announcement data? You in WSJ, Wall Street Journal market data, analyst focused, and you will get this data. And also there is some other sources to provide the whisper number. Analyst focus, whisper number is not entirely the same as the analyst focus, because analyst focus is a focused number in a analyst report. It's a very formal report. Whisper number is collected from the trading floors. So in hedge fund, mutual fund, they have a lot of professional researchers researching the different companies. And they have already calculated a number, but they haven't had time to write a very formal report. So some people are collecting this calculated number inside the research groups and publish them. Okay, they were insider information, but once they were published online, the whisper number becomes a public information. All of these can affect the stock price. Efficient markets are a result of investors trading on unexpected portion of announcements. The easier it is to trade on surprises, the more efficient markets should be. So basically, it's about how fast the market information is incorporated or absorbed or reflected in the market price. If a company 1 year ago says, we expect that our sales will grow 50%, and a lot of market researchers find that they actually can sell more than, so their sales growth could be like 75%. Okay, then the stock price will go up, because based on the researchers, the analysts, the research, is actually higher than the company's own expectation because the business is really good. Then when they announce their real sales 1 year later, the actual sales growth was 200%. That's way higher than the previously predicted number, expected numbers. So the prices will go up substantially. If the liquidity is very large, liquidity means that there were a lot of buyers and sellers of this stock on the market, then the stock price should go suddenly go up. That means the market is very efficient. If you find that, hey, it's 200%, but no one is willing to sell, and you want to buy this stock, you cannot find a seller. And if you want to sell this stock, you cannot find a buyer. Then the market is not that efficient. Okay. For example, there is a good news in the real estate market, and you know that the housing price is going up, so you want to buy an apartment, but you cannot find anyone to sell. Will this good news be useful? Not really. If you cannot make a transaction, then the news will not be reflected in the market transaction price. Then the good news, will be absorbed in the market price fairly slowly. So we say that the real estate market is less efficient than the liquid stock market. Okay. We say that for listed companies, because their stocks are publicly traded, so it's much easier for investors in these publicly traded listed companies' stocks to find potential buyers and sellers. The listed companies' stocks are more liquid than the unlisted stocks or private company stocks. Private companies also have the equity. They also have the stocks. But if you want to sell them, you have to find some people to privately transact this deal. And that is much harder than log into the brokerage account than just click buy or sell. Okay, so in that market, the private market's stock transactions, the market is less efficient. Efficient markets involve random price changes because we cannot predict surprises. Okay, before the real number is released, everyone is just guessing. And by the way, it is illegal for the people who own the private information to trade, because that will give the insiders a unfair advantage. For example, the EPS or the return or sales growth information, before they're released, some people have already known them. For example, the company's CEO, the company's CSO, this company's CFO, the company's CMO, the marketing officer, chief marketing officer, they have already known that. But if they use this, they find like, hey, our sales growth is 200%. Wow. If they start to buy their own stock, they have to apply and to report to the regulator, and to make their planned purchase public. So this information must be public, because once it's public, the outside investors will know, why do you buy your stocks? You must know that the sales growth or something is better than expected. So they can also buy, then so that to make the market transaction fair to almost everyone. Okay, hopefully everyone. If you just say, hey, I know the number and then I just trade and make money, this is illegal. Okay, you will be fined and probably will go to jail. Systematic risk is a set of risk factors that affect a large number of assets. So it's also known as undiversifiable risk or market risk. Okay. Systematic risk means that Okay, this is a risk factor that not just affects a particular firm, but all the firms of the same type. Be very careful about my wording of my type. Some factors are obviously risk factors, like alien invasion, okay, earthquake. The earthquake will affect all of the firms in this area and their suppliers and customers in the supply chain. For example, if the earthquake destroyed some Japanese firms, then the supplier of these firms will also be affected. So this is a systematic risk that will affect all the firms in this region and all the firms related with these firms. This is systematic risk. Systematic risk may not affect all the firms in the world. They may just affect all the firms in a group. Say, and they may not be just be area-wise. It can be industry-wise. Like the government has a policy to promote the electronic cars. This will affect all the electronic cars company or the traditional gas cars company and all the suppliers to both types of cars, steels, batteries. Okay, so this policy is a systematic risk. Before this policy is released, whether this policy will be released is a systematic risk to rigorously call this risk. It should be like this. Things like changes in GDP, inflation, interest rates, of course, they will affect all these are the country-wise variables, so they affect all the companies in this country. Well, if this is American GDP, Chinese inflation number, the ECB, European Central Bank interest rate, whether it's the US, China, or Europe, these will affect more firms than only the firms in their own country, because they are systematically important, and their suppliers and customers are not only just the firms in their own country, but also in the other countries. So these will affect the whole world's economy. The GDP, inflation, and interest rate in, for example, Singapore will be a systematic risk to all the Singaporean firms and their related firms, but not to the majority of firms in the world. Unsystematic risk can be also called unique risk, asset-specific risk, or a very good term, idiosyncratic risk. Idiosyncratic risk is not very easy to pronounce, but it's idiosyncratic risk. Or individual risk. This is the risk factors that only affect a limited number of assets, including things like labor strikes, etc. Systematic and unsystematic risks are relative concepts. Okay. Well, you can say the earthquake only affects like 5 firms. Is it a systematic risk or unsystematic risk? Well, it depends. But the risks only affecting one firm is definitely an unsystematic risk. For example, a firm's CEO's marriage status or a firm's CEO's health status will only affect this firm and maybe its supplier. Okay, that's an unsystematic risk. Returns. Total return is equal to the unexpected return plus the expected return plus the unexpected return. Just like realized return always has an expected component and unexpected component. Unexpected return has 2 parts: systematic return and unsystematic return. Therefore, the total return can be expressed as expected return, systematic return, and unsystematic return. Again, what is the surprise part? Surprise part is the unexpected return. The systematic and unsystematic portion can also contribute to the surprise, the unexpected return. No matter it's a government policy, systematic return, systematic portion, or it's a CEO's health. Like there is interestingly, there is a branch of academic research about the CEO's sudden death. So what happens if a company CEO just suddenly dies? Is it good or bad? And there are also a lot of some other scholars researching the sudden death of the company leaders. I'm sorry, the country leaders. That is a systematic portion. Okay, like the president dies. It's not just the one company. It affects all because the president dies may indicate a political turmoil or the turnover of the politicians, and therefore the increase the uncertainty of the future policies. Diversification. Portfolio diversification is investment in several different asset classes or sectors. It's not just about holding a lot of assets. For example, if you own 50 internet stocks, you are not diversified. But if you own 50 internet stocks in different countries, like 20 countries, you're diversified a little bit. Okay. If you hold 50 different industry stocks in one country, then you can diversify industry-specific risk. But you cannot diversify the country-specific risk. The full diversification may require you to own different stocks in different industries in different countries. And some are large, some are small. And if you want to further diversify, you probably want to invest in both stocks and maybe bonds, the other asset classes. Okay. The number of stocks in the portfolio and the portfolio standard deviation. This is from a paper in JFQA, which is a top journal. When the number of stocks in portfolio increases, you find that the average standard deviation of annual portfolio returns is decreasing. And when you have about 20 stocks in a portfolio, your average standard deviation will reduce to about like 21.68%. And then when you increase the number of stocks even more, the average standard deviation will only reduce decrease slightly. And this is a ratio of portfolio standard deviation to the standard deviation of the single stock. That means when you increase your number of stocks in portfolio to 20 stocks, you only bear less than half of or 44% of the average standard deviation of holding just the one stock in your portfolio. The principle of diversification is that the diversification can substantially reduce the variance or variability of the returns or volatility of the returns without equivalent reduction in expected returns. That is, it preserves your expected returns while reducing the volatility. So it reduces the risk by preserving the return, so it increases the return risk ratio. The reduction in risk rises because worse than expected returns from one asset can be offset by the better than expected returns from the other. For example, there was a very classic diversification example is that you sell sunglasses and umbrella at the same time. So no matter what the weather is, you're going to sell something. There is a real industrial level example is that some Arabic sovereign wealth funds, some Arabic countries, they have a lot of reserves in oil, right? But their wealth, the sovereign wealth funds are their governments' asset pool. So the government has a lot of money, and their government invested a lot into the electronic cars. Why is that? Because if electronic cars do not develop well, then people still use the gas cars, and they export oil and gas. They can make money. If the electronic cars automobile industry is developing very well, then the demand for gas will go down, and their traditional business will go down, but their stocks of electronic cars will go up. So this is a balance, and we say hedging. Okay, that's hedging, and also it's a diversification of your assets to reduce your asset return volatility in the future, and also enhance your stability of returns. There is a minimum risk of level of risk that cannot be diversified away. So you always have some risk that no matter what kind of diversification strategies you're using, it cannot be diversified away. That is called a systematic portion of risk. So when you increase the number of stocks in your portfolio, the average annual standard deviation will go down. And when you increase the number of stocks to 20, it goes, or a little bit above 20, then the average annual standard deviation will only decrease slightly. This is a risk that can be diversified. So when you increase the risk that can be diversified is the risk that can disappear when you increase the number of stocks in your portfolio. That diversifiable risk can be eliminated by combining assets into a portfolio. It's often considered as an idiosyncratic risk, unsystematic, unique, or asset specific. If we only hold one asset or assets in the same industry or assets in the same country, then we are exposing ourselves to a different level of risks, which we could diversify away by using more appropriate assets capital allocation strategies. The total risk is equal to systematic risk plus unsystematic risk. Okay, and recall that we learned that the total return is equal to expected return plus the unexpected return. The expected return doesn't have a risk associated with this because this is expected. No matter what, you're gonna get this return. Say you have an apartment and you rent it. You have an expected return, say $6,000 a month, and you have an unexpected part. The unexpected part can be related with risk. The risk that the person who rent your apartment may just ran away, or there is an earthquake and your apartment is just destroyed, something like this. Any unexpected return is associated with the risk, and the total risk has systematic portion and unsystematic portion. The standard deviation of the returns is a measure of total risk. Okay, remember that standard deviation of the returns is a measure of total risk, and your returns to award. We talked about the risk-return association, risk-return relationship. The return to reward that you bear the additional risk is to only award you to bear the systematic risk, not the unsystematic risk. Because the unsystematic risk can be diversified away by using some smarter techniques. So that part will not be rewarded. For well-diversified portfolios, unsystematic risk is very, very small. So your risk should only have the systematic risk plus a very small part of unsystematic risk. Consequently, the total risk for a diversified portfolio is essentially equivalent to the systematic risk. And that systematic risk, we call that beta. Okay, we will talk about that later. There is a reward for bearing risk, but there is not a reward for bearing risk unnecessarily. That is to say, there is not a reward for bearing unsystematic risks that can be diversified away. So we only reward the risk bearing for the systematic risk. The expected return on a risky asset depends only on the asset's systematic risk. Okay, and that systematic risk is called beta. Beta measures the correlation of your assets return and between your assets return and the market average portfolios. So the index portfolios average return. So what is a market portfolio or market index portfolio? That is, you averagely distribute or allocate all of your assets to every stock in the market. Say the market has 6,000 stocks. You just equally divide your capital into 6,000 parts and use each part to buy the stock. And then your return is mimicking the, well, some people will use a weighted average, not just the equal average. Some people say, hey, this stock is larger, so I just put more weight on this. That is also a different portfolio. But for simplicity, we just say, hey, you just allocate all of your assets into equally on each of the stocks in the markets, and that is market index. And that portfolio's return is market index return. And now, for example, Dow Jones. Dow Jones is a portfolio of the 50 largest firms in the United States. And so if you buy the Dow Jones index portfolio, that means you allocate all of your money to buy, use 2% of your money to buy one stock each. So 50 stocks you will spend 100% of your money to buy 50 stocks. And that is market average return. So beta is a correlation between your specific assets return and the market return. And beta can be 1, can be smaller than 1, can be greater than 1. Remember that beta is a correlation. So when beta is greater than 1, it implies that your asset has more systematic risk than the overall market. That means that when the market average return goes by 1%, if your beta is 2, that means your asset will go up by 2% statistically. And when the overall market index return is going down by 1%, that means the return is negative 1, minus 1%. Then statistically, your assets will go down by 2%. So if your beta is greater than 1, that says that your asset is more volatile than the overall market, has more systematic risk than the overall market. If your beta is smaller than 1, it implies your asset has less systematic risk than the overall market. What kind of assets have high beta? What kind of assets have low beta? Utility companies have low beta. Utilities, telecommunications, water supply, electricity supply. Those are the companies providing the goods. No matter what the market no matter whether the market is good or bad, people still use it. When even the economy is going to a recession, you still will call your friends. You probably will call your friends more. Okay, you still will call your friends. You will still use water. You will still use electricity, and you probably will still drink Coca-Cola. That's Warren Buffett said. I buy Coca-Cola because no matter what, they will drink Coca-Cola. And he also said, like, I invest in chocolate because no matter the economy is good or bad, people still eat chocolate. When people are happy, people eat chocolate. When people are unhappy, they eat more chocolate. So these companies, beta is more than one because these companies, their stocks are less volatile than the overall market. The luxury goods companies, assets, must have higher systematic risk than the overall market. I don't know the real data. I never looked at the real data, but I'm pretty sure. If I'm wrong, please tell me. I'm pretty sure. Like the LVHM, is that LVHM? It's the largest, the luxury groups in France. I don't even know. I never use the luxury goods, so I never know this. So these companies' assets must be more volatile. It must have more systematic risk than the overall market because when the market is going down a little bit, like people just the first thing that people do not want to buy is the luxury goods. They want to save the money to buy Coca-Cola or chocolate or call friends to complain. And if you never heard of this, but actually I talked a little bit about this in the very first class, but if you've never heard of beta, you probably are wondering, where is alpha? Because we always say alpha, beta, but here is beta. Beta basically, in finance, beta basically tells you the trend. Okay, when the market is going up and going down, the market movement is a beta because no matter beta is more than one or greater than one, it measures how much you go with the market. When the market is going up, you also go up. Your asset is also go up. It's just a matter of you go up more or less than the market return. The beta is the market movement. The alpha is the abnormal return. Okay, it's the abnormal return. We will talk about that in the future. And let me tell you a very good trick to show that you are very professional. In any interviews to the financial companies, if people ask you, we come to interview our hedge fund, tell me, what are the hedge fund managers trading on? Some people say, oh, they trade on stocks, they trade on futures, they trade on commodities. I tell you a good answer. You tell them they trade on alpha or beta. That sounds very professional. If they trade on alpha, that means when they trade any assets, they use the market average to hedge the systematic risk. And they only trade on the idiosyncratic risks. If they trade beta, that means they only trade on the systematic risks. For example, you buy a Chinese stock or American stock, and at the same time, you short, or basically short means sell, long means buy. You long the specific stock, but you short the market index futures. That means you're betting that your stock will perform better than the market average. And that is an alpha strategy. You're trading on the alphas. If you are buying a, say, US technology firm ETF, exchange traded funds, these funds will go with the market movement. When the market is going up, when the market is going down, it will go up or down with the market. Then we say you are trading on beta. When you're trading on alpha, it doesn't matter whether the market is going up or down. Because when the market is going down or up, your stock is also going up, but you're trading on the difference. You bet that your asset, your stock, is better than the average stock in the market. You're trading on the abnormal parts. And when the market is going down, yes, your stock is also going down. But if you think your stock is better than the market average, then your stock will go down less than the market average. So you're trading on the stock price minus the market return. Minus market return, you implement that by selling the index futures. Okay, that is alpha. Anyway, probably this is too difficult and beyond the level of the undergrad course. But let's get back to the beta. So beta smaller than 1 implies that the asset has less systematic risk than the overall market. The beta greater than 1 implies that the asset has more systematic risk than the overall market. And let's take a look at the beta. Coca-Cola, the beta is really small. It's only 0.35%. Because no matter it's a booming or recession economy, you always drink Coca-Cola. Microsoft, it's also it's like Microsoft now is like infrastructure in the information age. No matter it's recession or what, you still have to use computers. Google, no matter what the economy is, you gotta use Google. Okay. JCPenney just, if I remember right, JCPenney just went bankrupt early in 2020 because of the COVID-19. Am I remember this right? Maybe correct. So Tesla, it's electronic automobile company. JCPenney is a teenager or young people clothing company, shopping, and these betas are greater than 1 because when the economy is too bad, you probably don't want to buy the expensive Tesla automobile. You probably just want to buy the very cheap automobile, and you probably don't want to spend more money on the JCPenney to buy more clothes. Just buy like say $10 T-shirt. Maybe that's enough. For Asian companies, for example, Sinopec, China Mobile, these have the very small beta because no matter what, you gotta use some product made by petroleum, and even the economy is really bad, you still call. Even if the economy grows very fast, you don't call your friends like 10 times more, right? And the third one is Indonesia telecommunication company. I don't read Indonesian, but I just assume that this is telekomunikasi. Sounds like telecommunication. Yeah, I think it's. I guess if I'm wrong, tell me. I think it's similar to China Mobile. HSBC or Tata Motors. Tata Motors is HSBC is a Hong Kong and Shanghai Banking Corporation's a British bank headquartered in Hong Kong. Then it moved to London. It's a banking company. The banks have higher beta, which is understandable because when you're richer, when the market is really up, they have more businesses because people want them to do some money management business, so they can charge more money. But when the economy is really bad, they don't have money for you to manage, so you don't have business. Tata Motors, in India, they sell the automobile, and the beta coefficient is really high. That means when the economy is really down, then Indians will not buy automobiles because compared to the average income, the automobiles are still relatively expensive to the local average income. Total versus systematic risk. Consider the following information. Citibank and K. What is K? K is Kellogg's, the food producer. Okay, we CNK standard deviation of security C is 20%. Beta is 1.25, and K standard deviation is 30%. Beta is 0.95. Which security has more total risk? Of course, it's K. When we are talking about total risk, we are talking about the standard deviation. Which security has more systematic risk? Is C. Because when we talk about systematic risk, we look at beta. Which security should have higher expected return? The answer should be C, because expected return is only associated with systematic risk, but not the total risk. K has more total risk because it had more unsystematic risk. Consider the previous example with the following four securities. Wow, this is many slides ago. Okay, what is the expected beta? The expected beta, the portfolio beta, is calculated by the weighted average of betas. So we just simply multiply each weight by these corresponding securities beta. Then we calculate the weighted average, and we find that the portfolio beta is 1.947. And beta is closely related with the risk premium. Recall that risk premium is not a risk. Risk premium is the abnormal return. It's a return minus the total return minus the risk-free returns. That the higher the beta, the higher the risk premium should be. Can we define a relationship between the risk premium and the beta so that we can estimate the expected return? The answer is yes. And we use the market security line. So portfolio expected returns and beta can be plotted in the following figure. When the beta goes up, we expect that the expected return should go up. Even when the beta is 0, that means this asset's return does not vary with the market return at all. We still need to have some expected return, because if your return is 0, no one will buy your asset. Okay, and assume this is a straight line, and here is the expected return. The vertical axis value is the expected return, and the horizontal axis value denotes the beta. And this is the risk-free rate. Even though your beta, systematic risk, is 0, we should have some expected return, that is risk-free rate. So we know that this one minus this one is this. The expected return minus the risk-free rate is this part. And this divided by this, or this value, beta. This minus this is tangent, right? It's tangent. It's tangent this angle. So, or the slope. We call it the reward to risk ratio. It's a slope of the line illustrated in the previous example. It's calculated as 20 minus 8, 20% minus 8% divided by 1.6 minus 0, and it's 7.5. What if an asset has a reward to risk ratio of 8, higher than this 7.5? It's a good asset worth investing. But in the effective market, this reward to risk ratio of 8 assets should not exist. Why is that? Because if we have an asset that has a higher reward to risk ratio, then what will happen? All the people will not buy the reward to risk ratio 7.5 asset. They will just buy the 8. Not all of them, because people have different, risk aversion. Some people just don't. Some people not only look at the reward to risk ratio, they also look at the absolute risk level. They just don't like high risk products. These risk averse people. But assuming that the market has a lot of financial products, there are some products with the same risk, but their reward is their return or risk premium is lower than the reward to risk ratio of 8 product, then no one will buy the lower reward to risk ratio product, but go to buy the reward to risk ratio of 8 product. If so, what will happen? If so, if there are many people demanding this product, the price will go up. The price go up, meaning that they don't have to pay you this much. They can pay you a little bit less and retain because any financial product is supplied by some, for example, hedge fund or some financial product suppliers. So they can just give you less reward until the reward to risk ratio of this product is the same as the others. Okay, so in the long run and in the equilibrium market, effective market, the reward to risk ratios of different assets should be the same. Okay, and what if an asset has a reward to risk ratio of 7? No one will buy it. Well, not no one will buy it. If they have some competitor with the same risk but higher reward to risk ratio, then people will not buy it. And this financial product will die out from the financial market, and suppliers will stop the business because no one will buy it. And supplying, by the way, supplying a financial product has relatively high cost. So when you are buying some mutual fund product or hedge fund products, the fund suppliers, they supply a financial asset for you to buy. They have registration costs, they have regulation costs, they have to file reports, they have to hire some people to get the license, and all of these are very costly in many countries. So that's why they also charge some management fees, okay, from your investments. But if their assets reward to risk ratio is too low, they will stop supplying it, because if no one buys it, it's like ice cream. If you spend cost to produce it, but no one buys it, then you're losing money. So you will make this asset die out. Eventually, in equilibrium, all the assets and portfolios must have the same reward to risk ratio, and they must all equal the reward to risk ratio for the market, because the market index is also an asset. That is a portfolio that I talked about before. You evenly distribute or allocate your assets to buy each of the stocks equally. That is a portfolio, and that is the most brainless portfolio. It's very simple. The algorithm is very simple. It doesn't need a lot of the analysis, and it doesn't need very advanced. You don't need a PhD to do this. Okay, it's very simple. Anyone can do this. So, if this is true, then we know that for any asset A, your expected return of asset A minus the risk-free rate divided by the beta of A must be equal to any ERB minus RF divided by beta B. Any other assets. All the assets must have the same reward to risk ratio, so that even for the market index portfolio asset, you should have the same reward to risk ratio, which is ERM. I'm sorry, it should be ERM here minus RF, but it's the same because ERF, the expected value of a risk-free return is just the risk-free return itself. So the parenthesis, the right part of the parenthesis here or here, it doesn't matter. So this must be true. And the funny thing is, what is beta M? The beta, if you still remember that beta is the correlation between the assets movement, assets time series return, and the market time series return. If the asset is market index itself, the correlation should be 1. So beta M is just a 1. It's just a 1. And if you move this to here and you rearrange this formula, you will get this formula. Okay, let's finish this one first. The market security line is a representation of the market equilibrium. The slope of the security market line is the reward to risk ratio. I just find that yeah. So since beta for the market is always equal to 1, it can be rewritten as this. And if you move this to here, it's beta A times ERM minus RF plus RF, which is this. Beta A times ERM minus RF plus RF. And ERM minus RF, this is a risk premium, and this is market risk premium. Because market index also is volatile, so the return to the market is also higher than the risk-free return. If we don't know asset systematic risk, we can use this formula to determine its expected return. Okay, this one is called CAPM model, the capital asset pricing model. Okay, this is true whether we are talking about the financial assets or physical assets or any assets. Okay. Remember this one. This one will surely be covered in final exam. Surely. Factors affecting the expected return. So this part measures the risk-free rate. The risk-free rate is not associated with any risk because it's risk-free. It only captures the time value of money. Okay, and reward for bearing systematic risk is measured by this, and the amount of systematic risk is measured by the beta. Okay. Example: consider the betas for each of the assets given earlier. If the risk-free rate is RF is 4.15% and the market risk premium is 8.5%. Market risk premium is ERM minus RF. What is the expected return of each? You just need to know the beta, and you plug these numbers into this formula. This is market risk premium at 8.5%, and this is a 4.15% for the risk-free rate, and you can calculate the expected return for each of the securities. And this is the market security line, okay, which is almost the same as the security market line. I'm sorry, security market line. And we have some quick quizzes, which can be covered in the tutorial and the comprehensive problem. So in this chapter, the most important one is how do you derive this, the CAPM model, which is, you remember that for the stock pricing, we also have the dividend growth model, right? The dividend growth model is just for the dividend growth. We have to assume that the stock has dividends. A lot of stocks don't have dividends, and you have to assume that the dividend grows as a constant level. Many stocks really, even though they have dividends, they don't have dividends growing at a constant level. But for this asset is not just for the stocks. It can also go for the other assets, but not all the assets, but some assets. So this is another more general way of calculating the expected return of stocks for any asset A. So this chapter is over. The next chapter we will talk about the weighted cost of the weighted average cost of capital. We will talk about the corporate financing. Thank you.